Welcome to the next edition of Pizz-Spectives. My name is Pizzichetta, founder of Mont Wealth. And today we're going to reflect, but then also look forward on the outlook for assets. But to start, let's have a look at the Wholesale Managed Account FY25 performance from Mont Wealth Managed Accounts. We have two accounts here on portfolio accounts. The multi-asset strategic growth portfolio that delivered 16.3%. That is after active management fees, but before Mont Wealth and platform fees. And then the multi-asset income portfolio that delivered 10.6%, again, including active management fees, but excluding the Mont Wealth and platform fees. So as we move forward, the disclaimer, anything we discuss today is general information only. Anyone acting on its advice does so entirely at their own risk. So please go and seek financial advice or give me a call. My details are on the screen there, and they'll be in the podcast notes as well. So let's move forward, talking a little bit about our investment committee. Obviously, myself as the chair, we have Vesla Tasco, Jay Kumar, and Shane Lee. We meet monthly. We discuss all things macro, micro, and asset allocation strategy. Our strength is our diversity in our thinking and our experience. And in between meetings, we do a lot of work around fund manager meetings, thoughts, and idea generation. And we bring that all together for our 90-minute investment committee meeting on a monthly basis. So the next part, obviously talking a little bit about our 5-step investment process. We talk about investment objectives. There's two-pronged. Firstly, it's for accumulators that are looking for either growth or balanced investment, and it's what we call a strategic growth. That objective is 8% return per annum through the 5 to 7 year investment cycle. And the other one for income or conservative investors, we focus on the RBA cash rate plus 3%. Then putting that together, how do we strategically and tactically approach asset allocation? We look at fund managers, we do the research and we select, and then we ultimately have a look at the underlying investments, ensuring there's little correlation or overlap in the managers that we select. And then we implement the portfolio and ongoing monitoring via our investment committee meeting and also on a daily basis for myself. Again, talking a little bit about the accumulators and growth investors, objective is 8% return per annum over that 5 to 7 year period. Strategically and tactically allocating capital to meet the objectives through the cycle. And we try to be aggressive when the investment environment allows, and then defensive when the investment environment requires. We do not believe in box ticking. Depending on your risk profiling, we are here to advise you on when you can be aggressive and when you should be a defensive investor. Also for retirees and income seekers, the target there is the RBA cash rate plus 3%. But again, we strategically and tactically allocate capital to meet the objectives through the cycle, but by identifying the best asset classes to achieve those objectives and also generate maximum returns and then stabilize capital. We also try and protect on the downside with lower volatility, and I'll explain a little bit more about that a bit later. Now, if we talk about the investment process, this is going to be a theme going forward for a long time, so be aware of this. And I think we should be mindful of how we think about asset allocation going forward. So in the period of 1980 to 2020, which was disinflation, low rates, and asset price appreciation, baby boomers were the drivers of the economy. They had double income, globalization, supporting where things were manufactured, the lowest cost provider. Technology started just evolving. Obviously, e-commerce and technology and the internet started in the late 90s and early 2000s. We had cheap energy. We didn't care too much about fossil fuels. There was a period of disinflation, lower tax rates, and lower risk-free rate, which supported returns. Beyond 2020 and COVID, though, inflation reared its ugly head. We saw higher rates to stop that inflation. And we also probably expect lower growth and lower returns going forward. We'll talk a little bit about the IMF's view. And the new drivers will be, while baby boomers are retiring, the double incomes then have taken on more debt. We're seeing the globalization is shifting now to reshoring, and there's a lot of spending going towards the US at the moment. Now, technology will continue to evolve and innovate, and obviously AI will be a large driver of that. Cheap energy has shifted to renewables, not everywhere. It's gone back to the US of cheap energy. But no doubt renewables will be a key focus going forward. That debt that we took on has now become a burden, and with interest costs being elevated, inflation, albeit slowly coming down, is still probably going to be higher than what we've been used to for a long time. And then a drain on growth as well is going to be government deficits and how they tax wealthier individuals to fund that deficit or debt. Now, when we look at the new market cycle, and obviously past performance does not guarantee future performance, asset allocation needs to evolve. We have to think about adjusted risk return to meet objectives. And obviously the structural drivers become the new growth assets, and talk a little bit about that, and especially AI and infrastructure will drive that going forward. Now, historically, the investment process was all about the market cycle. When interest rates started falling, equities and real assets became the go-to asset classes to create wealth. And as growth moved above trend, we started to see inflation rising and interest rates going up. You started shifting asset allocation back towards cash. And as interest rates rose and growth moved below trend, bonds were the place to be. And then as the cycle continued, inflation starts falling to target because the economic growth slowed down. You start to move to equities. So there's an evolving cycle in markets and asset allocation. But in the middle of that, there's also the alternatives, which is gold, private equity, and private credit, which provides stability to the portfolio, and it helps reduce volatility and stabilize capital. But what's happening in the market now is that investors are moving well ahead of what we're starting to see, where growth's moving above trend and interest rates start coming down. We're not really seeing the aggressive rate cuts that we expected, but equity valuation and asset prices are at historic levels on both valuation and peak index pricing. So when we look at the outlook for 25, our view hasn't really changed, but in fact, the sentiment has improved, but the base case is still no recession. There might be a chance for economic slowdown depending on how severe the tariff policy has become, but it hasn't been as bad as feared, probably settling somewhere between 12 to 15%, as opposed to where Liberation Day scared the world and where it may have gone. So we believe that there's a base case of no recession, solid economic growth, but probably not as high as we'd experienced from that 2010 to 2020 period. Now, when we look at the Mont FY25 performance, as discussed earlier, the strategic growth portfolio delivered 16.3% and the income portfolio 10.6%. But when you compare that to the household names of their balanced or growth portfolios, Vanguard delivered sub 14, AMP about 13, Colonial First State about 12.5, Aware sub 12, Australia Retirement Trust below 12, CBUS just above 10, Hester, MLC, Rest, and Aussie Super. Our Aussie Super finished at about 9.5%. So our performance was very good. We've taken obviously a strategic approach about how we allocate capital and an active management approach as well. So very pleased with our performance. But then going forward, it's all about the outlook. Now, when we look at what actually drove the performance for the growth portfolio, active managers in global equities really drove that performance. They delivered 25% capital growth over the period. And when you look at what the asset class index return did in that same time, it was sub 20%. Similarly, for the international fixed income, where we've got an allocation that delivered close to 9%, where the index delivered just over 5%, the alternative delivered close to 14%, and the index delivered about 10%. And the Aussie equities delivered close to 17%, and the index return was sub 15%. All in all, really strong performance. Interestingly, too, infrastructure was a great alpha generator for the portfolio. We've got 10% allocation to global infrastructure. It delivered close to 27% growth for our 10% allocation. It was slightly below the index, but nonetheless delivered really strong returns, and we're quite happy there. And then when we look at the asset allocation exposures and on a strategic asset allocation benchmark, the Aussie equities is pretty much banging in line with where we want to be, around 18% of the total portfolio. Global equities, we'd love to be about 20%, but we've actually increased that exposure to 23%. We've increased our exposure to global small caps, and we've also increased or introduced a new position in Indian small cap companies. And there's a podcast about the future winners of India. Also, the Australian fixed income exposure, we sit at 11%, but the asset allocation benchmark suggests we should be around 7%. And then the other one of note too is our cash current level is only sits at about 4%, where our SAA benchmark is closer to 6 or 7%. So we're happy to be underweight cash. We believe we can get really good returns out of other asset classes, including Aussie fixed income and also the alternatives, which is private credit. Very happy with that exposure. Now, we've also done a bit of stress testing for our portfolio. Now, those that are on the YouTube can see these bar chart, and those on the podcast, I'll try and explain it the best I can. So we've gone back in history, we've replicated our portfolio and tried to get a sense of how this portfolio would perform in a down market. Now, interestingly, when the taper tantrum occurred in 2013, the benchmark fell 2%, but this portfolio only fell 1%. And closer to the COVID-19 crisis of 2020, the benchmark fell 11% and our portfolio fell 7%. And then also in the 2022 market sell-off, when interest rates started going up aggressively, the benchmark portfolio fell 5% and our portfolio fell -2%. Another way of measuring risk and return and volatility. Now, when we look at the benchmark itself, the portfolio would deliver circa 5% of volatility, but our portfolio has circa 3.7% volatility in the portfolio, again, highlighting the lower levels of risk in returns. But then also the performance of the last 2.5 years has delivered 10.6%, and the benchmark has delivered 9.9%. So we're driving greater returns with less volatility and less risk. So very pleasing as an investment committee and a chairman of that to see these kind of numbers coming through. Another way of explaining it too, a lot of people are always a little bit concerned around the share market. So what we're trying to do is measure the performance of both the income and the growth portfolio in periods of volatility. And obviously in 2023, there was a little bit of a slip up in the market. The ASX 300 fell circa 7%, but our portfolio only fell 3% in that same time. And in fact, has kept up with the portfolio ever since. And also more recently during Liberation Day, when the ASX 300 fell close to 8%, for our portfolio was only down about 2%. And at the same time, the income portfolio has been a steady grinder higher, which supports exactly what we're trying to achieve here: capital preservation, income generation, and a little bit of capital growth at the same time. There's also another chart that highlights very similar attributes where when there's periods of volatility, the blue line highlights that the Mont Wealth growth portfolio is relatively steady when there's periods of weakness, and we continue to perform very well and ahead of objective. Now, when we break down the asset allocation strategy, the Aussie equity exposure, as we just highlighted earlier, about 18%, and it's broken up into 3 parts: Aussie equity income, Australian small caps, and Australian hedge funds. And then when we break down the global exposure, again, quite diverse and very well spread across emerging markets, Indian equity markets, global mega caps, global small caps, global mid caps, and global thematic, which we see as robotics and AI, which is the future there. Also on Australian bonds, 11%, global bonds, 7%, cash position of 4%. And we've also even recently diversified even further our private exposure to ensure there's a limited risk in our exposure to private credit. We now have corporate lending, real estate debt, and the new Aurora exposure through SME lending. And we also have a 3% position in gold. Global real estate sits at about 4%, and global infrastructure at 10%. As we highlighted earlier, it is or was a great driver of performance, and we think it will continue to do so as the AI demand for electricity continues to increase. Now, albeit this is the managed account, wholesale managed account portfolio, we've tried to replicate this exactly the same in a retail format. Those that require a statement of advice that we invest monies for, and we've tried to replicate it as closely as possible. And so I'd love to discuss with you if you are a retail investor to help you out as well and meet your objectives. Now, when we look at the income portfolio, again, as I highlighted earlier, it delivered 10.6% return for the 2025 financial year. The international fixed income was the standout, delivered almost 9% versus the passive return of sub 6%. Australian fixed income was close to 8% versus passive at about 6.5%. Aussie equities was almost in line at 13.5%. Alternatives almost in line at 9%. Infrastructure again. Now we've taken a hedge position in infrastructure for the income and conservative portfolio, and it delivered close to 20%. But we underperformed on property, and we also underperformed on global equities as our managers took a much more conservative approach. And we don't mind that, given it's a conservative and capital preservation style for investors. So we're happy with that, but we'll keep a close eye. And the other thing too that gives us a bit of comfort is with equity valuation so stretched, we'd much prefer to take a defensive stance on the income portfolio. Again, where we are overweight, global equities slightly at 12% versus the benchmark recommendation at 10%. Also, the Aussie fixed income, we're at 13%, we're against the benchmark recommendation at 10%. And the other one is global infrastructure, we're closer to 12%, and the recommendation is at 10%. And also our cash position currently at 6% versus the recommendation at 10%. Again, as noted earlier, we're happy to be overweight some of the Aussie fixed income, which is giving us 6 to 8% income distribution versus cash closer to 4%. So it's all about maximizing your returns with a limited risk and capital stability. Again, looking at the performance over the period, we see that in periods of weakness that the income portfolio holds true to label, capital stability, and income generation. Again, as we've gone through the portfolio, it's a good split across Aussie equities, the frank dividends, as well as some growth through Australian small caps. It's a new position for us. Also, global equity income drives distributions, Australian fixed income up 13%. And it's a good blend, roughly a quarter across all of the main asset classes of equities, bonds, private credit or alternatives, as well as real assets. So when we look at the outlook, now recently the IMF has just projected their thoughts for the rest of 2025 and 2026. Now, global GDP is projected at 3% in 2025 and 3.1% in 2026, slightly above April forecast, but continues to be below what the previous decade had averaged of closer to 3.5%. So the new norm is around 3% GDP growth. The upgrades reflect front-loaded trade, looser financial conditions, and softer US tariffs, as we discussed earlier. And the risk remains skewed to the downside with tariff escalation, which may have abated for now, but we still haven't seen anything coming out of China, fiscal deficits, geopolitical tension, and policy uncertainty. Now, in the US, the IMF expects growth at 1.9% in 2025 and 2% in 2026, but subdued. This is supported by front-loaded investment and the Big Beautiful Bill, which will drive fiscal stimulus and support aspiration. But unfortunately, inflation with tariffs will remain above target. But we'll talk a little bit about that later because we think that's a 2026 issue and thereafter a major piece because we think that tariffs are a one-off in nature. Now, Euro growth of 1% and 1.2 in 2026 driven by Ireland's export surge, but broader momentum remains soft. In China, growth upgraded to 4.8 and 4.2 in 2026, led by non-US export and fiscal support, and the front loading will fade. In emerging markets, growth at 4.1 and 4 in 2026. India remains strong at 6.4 in both years, hence why we've taken a better and a bigger position in India. And in Australia, growth will reach 1.8% in 2025 and 2.2% in 2026, aided by global demand, but domestic consumption will remain subdued. Now, when we look at asset classes and yield or income that we generate out of assets, those watching YouTube now can quite easily see this, that the ASX 200 is yielding just above 3%. Cash is giving us similar returns and property at 3.5%. So what that tells you is the income distribution that we're expecting to get out of equities is fading and fading fast. So we really need to focus on high yield Australian dividends. And unfortunately, it does not include the banks anymore, hence why we have taken an active position and reduced our exposure from passive to active in high yield ASX. The yield that we find a little bit more attractive still is in the global infrastructure and corporate bonds space. We see that we're getting 5 to 7% returns from global infrastructure dividends, but then corporate bonds are delivering 6 to 7%. And again, we're investing in balance sheets, good blue chip balance sheets. And the other driver of distribution growth is coming out of private credit. Both we spoke earlier around SME lending and corporate lending, but we're also getting it out of real estate debt. So we're getting close to 9% at the moment annualized. So really strong income distribution, and we're really happy to be well balanced across those. And we do believe that at some point, either the RBA needs to cap rates aggressively by at least another % to make the ASX 200 really attractive. But right here, right now, we think that we're not going to get much out of reporting season. In fact, we're probably going to get low single-digit EPS growth out of the ASX 200. So we really need to be active as an approach. But at the same time, we need to be active globally because tariffs will have an impact. And we're starting to see that across some of the industrial companies globally. When we talk about recessions in the US, it's part of the reason why there's a bit of a volatility or nerves around equity markets. But without a recession, there's little fear in equity markets except for valuation and some increased volatility. But only going back a few months, the possibility of a recession in the US was close to 45-50%. It's now come back towards 30%. The other thing, as we discussed earlier around inflation to keep an eye on, is that 2026 will probably see the re-peak of inflation, given the tariffs will kick through. The expectations is that inflation will rear its ugly head again at the start of 2026. Close to 3 to 3.5%, and then it will trend back down again, as I said earlier, around AI and productivity. but then also tariffs being one-off in nature. So if that's the case, we get a little bit of volatility in this period, but once we look forward, 2027 and beyond, we're probably going to get a much more normalized rate of inflation, which allows central banks to cut rates. And obviously, Trump is looking for someone that's a little bit more dovish, as the government has big interest bills to be paying with the debt that they've got on their balance sheet. The other concern we have for equities is the valuation, and very rarely are they this stretched. And they were about 3 or 4 years ago when interest rates were zero, but interest rates aren't zero at the moment, which gives us some concern. And a lot of investors are pricing in bull case scenarios or blue sky scenarios for the artificial intelligence and semiconductor exposures. We're happy to be there, but not overly weighted as a result. And then explaining earlier why we're only 5% of our portfolio in global mega caps. Now, when we talk about concentration risk, this is also something to be mindful of. And this is if you're a passive investor, just investing in the index, this is exposed. So in Australia, the ASX 200, 12% or 11.5% of the portfolio or the index is Commonwealth Bank. Then we've got BHP at 7 and CSL at 5. So really, if you combine all the banks at BHP, and you'll have the index weighting of 31%. So you really need those 5 companies to drive earnings growth for the ASX 200 to really drive higher. So we're happy to be active in this space because we think there's too much concentration risk. The same could be said for the S&P 500. Nvidia is 8% of the portfolio, Microsoft 7, Apple 6, Amazon 4, Meta 3, and you can see them to the Magnificent 7 make a big chunk of the S&P 500. So we really need them to continue to drive earnings higher. Otherwise, there might be some wobbles in the S&P 500. Hence why we are promoting active management at the moment who can selectively navigate through this uncertainty. Now, when I look at our portfolios, historically, a balanced or a growth portfolio is either 60-40, 70-30 when it comes to growth and defensive assets. At the moment, our growth exposure is 62%. And our defensive exposure is around 38% in our growth portfolio. So we are well balanced, slightly closer to the 60-40 portfolio, but yet still delivering growth-like returns because of our exposure to some of our selective asset management, as well as our private credit exposure delivering equity-like returns. On the flip side, the Mont Wealth income portfolio is currently close to 50-50, 51% growth assets and 49% defensive. The growth assets actually include real estate and infrastructure. So that's 20% of the portfolio. And the rest obviously is a combination of equities, but then also private equity that we have in our portfolio. Now we'll talk a little bit about superannuation. Now the guarantee has increased to 12% going forward. Maximum concessional contributions remain at 30% per annum. Non-concessional contributions remain at 120, or you can use a bring forward of 360,000 over a 3-year period if you're under the age of 75, with caps applying on your balanced super of $2 million on the 1st of July 2025. Obviously, we continue to promote using the carry forward rules, but then also the downsides of contributions. And you can contact me if you've got any questions around contributing into super. And then finally, as I discussed earlier, anything we discussed today is general information only. Anyone acting on this advice does so entirely at their own risk. And hopefully that gives you a bit of comfort on how we're allocating capital going forward. And we are very comfortable in how we're positioning our portfolios. Past performance is not a guarantee for future performance, but we're quite balanced across the board. If anyone's got any questions, email me at rob@montwealth.com.au.